Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. A 240-point recovery from the lows. A lot of commentary coming in on US-India trade deals as well. The markets, as Magna was stating in his F&O link as well, was oversold. There was a point for recovery as well. A lot of things happened together, and look at the move.
Yes, right. A perfect storm, but in a positive manner is what we saw, especially in the last half hour or so. Markets have recovered very sharply. Nifty as well as Nifty Bank trading with positive or trading with gains. But a lot lined up for the show, an important conversation as well. So let's start off with the top headlines. Market sees a sharp recovery triggered by comments on trade talks by the US ambassador to India. The Nifty recovers over 200 points from the lows of the day, while the Nifty Bank is up over 500 points from its intraday lows.
A CNBC-TV18 news break is confirmed. Lemon Tree Hotels in the green after it announced a major reconstruction plan to unlock value and split its asset-light management business from hotel ownership portfolio and brings Warburg Pincus as a strategic investor in one of the hotels.
Capital goods stocks tumble for another session as the risk of more competition comes in if the government eases curbs on Chinese companies, and that continues to weigh in on sentiment.
Manappuram Finance gains after the company issues a clarification regarding reports of the RBI delaying the firm's Bain deal to acquire a controlling stake.
Tejas Networks falls more than 10% in trade as Q3 revenue remains weak on a year-on-year basis. Weak sales and delay in major BSNL orders impact the company in the third quarter.
Okay, those are the top headlines. The biggest headline being the market recovery. The Nifty is up 50 points as we speak. At a point in time, it was only the metals index which was in the green, but we do have that recovery come by in bank, CPSE index, the FMCG, PAC, and the IT names as well. Of course, we have big IT names which will report results today, so we are watching out for that one. And other than that, the advanced decline ratio, which was actually in favor of declines, the ratio was 1:6. It's just 1:2.5 right now. So big moves.
That's right, and especially the materials pack, that's seen quite a bit of a sharp up move. The auto ancillary pack, remember, all of them were down anywhere between 3 to 5%. Names like Bharat Forge, Sona Comstar, all of them recovering quite smartly from the intraday lows. But these names and a whole host of other stocks is what Sergio has on his radar. He's standing by the wall. This is our special segment, Mid-Cap Movers.
So while market has made a smart recovery in the last 1 hour after the comment that came in from US Ambassador to India, Sergio regarding the US-India trade talks next round is going to be held tomorrow. But there is one segment which remains under pressure is the realty space, and that comes after Signature Global's comment or basically raising concerns related to the guidance for FY26 that company had given. And you can take a look. Signature Global still down almost 6%. Prestige Estates, Godrej Properties, Oberoi Realty, all these stocks are trading with cuts of somewhere in the range of 2 to 3%. But in the last 1 hour, we have seen some unusual movers. So first name on the list is IEX. Remember, on the Friday, while the hearing was on in the Electricity Tribunal, that is APTEL, the stock had fallen as much as 10%. But today, despite till 12 p.m. market was weak. This stock was holding on to the gains, and still it's up more than 3%. And also, if you take a look from the high of 160, that day it had fallen to 137, and today it's back of 140. Now it's trading near very important levels of 50 DMA and 100 DMA. So till the time it holds above 140.65, it would be important for IEX. Second name comes to Central Electronics. Now this stock also has seen a big gain in the last 1 hour, and that came with healthy volumes. And from December 26 till January of 9, it had seen a big fall. But what were the losses had seen in those trading sessions? It has recovered in a single day, and that is today. And volume currently is at more than 2 lakh versus 10-day average of just 20,000. Next name comes is JTL Industries. On Friday, stock had hit 52-week low of 51.39. And from that level, it has seen big buying. And today, currently, it's up more than 16%. And for this also, volume is at over 2 crore versus 10-day average of just 7 lakhs. Next one, LG Rubber. Like JTL Industries, this too has seen a big buying after hitting 52-week low. 52-week low was around 40, and from that level it has seen a big buying, and gains are coming with healthy volumes, and this too currently trading with gain of 4%.
Okay, some interesting names which are buzzing in the broader markets. We are not talking about them enough, considering no news flow, but it's a big move. So thank you for bringing us those names, Sudarshan. These are some mid-cap movers. But with that, let's move on and welcome Ruchit Jain, Equity Technical Research, Wealth Management from Motilal Oswal Financial Services. Ruchit, what a move. Do you think we could see further uptick from these levels?
Yeah, hi, very good afternoon. Well, you've seen 5 days of consistently selling, in last few trading sessions, and post the today's move that we saw in the morning, the RSI readings were a bit in the oversold zone. So I think this back move was warranted because of that oversold setups. But whether that would lead toward bottoming out of the markets and next leg of uptrend, I think that as of now does not seem would be that easy. So just because of that oversold setup, it seems to be a pullback move. Recently, we have breached that 50 DMA on the Nifty, which was important support. And until we reclaim that 50 DMA level again, I think this should be seen as no pullback move. So on the higher side, the resistance would come around 25,900. So one can expect another 150 odd points up move from current levels. But closing above that 25,900, 950 would be the most important thing to watch out for.
Okay, Richard, so 25,900 is the line or the level that you're watching for some sense that you probably believe that there is a significant reversal. Well, Richard, what are your individual trades for the day?
A couple of names on the long side. So one theme that we are looking out is looking for such stocks which have not seen that sharp corrections in last 5 trading sessions when the markets have corrected. So the relative outperformers, during corrective phases, two such names. One of them is ICICI Bank, where from the recent low, good price volume action has been seen. So ICICI Bank looks positive from current levels with a stop below 1380. One can buy for potential up move towards 1500 kind of levels. And Tata Steel is one of the metal name that technically looks positive. A high top, high bottom structure. Last few trading sessions in the dip, the 20 DMA has now acting as a support. So Tata Steel is one of the metal name that we like at current levels. One can go along with stop loss below 176 for potential targets around 190.
Okay, all right. Thank you so much, Ruchit, for joining in as always with your technical picks and moves on the index as well. That's a technical check coming in. But with that, we'll slip into a short break. A lot's happening in the realty space. So we'll get chatting with Pankaj Kapoor, the founder and MD at Liasis, for us to understand demand environment in the residential real estate sector. Stay tuned for that.
Welcome back to Mid-Cap Radar. Well, one particular pocket of the market that has seen significant selling pressure has been the capital goods space, be it inverters, be it companies that make transformers, and be it BTG generators. Winnie joins in with more details as to what it means if Chinese players are allowed to enter the Indian capital goods space, especially in the power sector. Winnie, you've done some comprehensive research on this. Please share details.
Hi, thanks so much for that. Yes, so what happened actually for the capital goods industrial space? Last week, we had some reports that came in from Reuters that suggested that high-level government committee recommendations came in by the Finance Ministry, which is planning to scrap the 5-year-old restriction that was there on Chinese firms bidding for the government contracts. Now, obviously, this restriction came in place in 2020. After that, we saw a sharp fall that came in for all these capital good players. Whether you look at an L&T, BHEL, these are the companies which are in those boiler turbine generator suppliers, that is the BTG suppliers. Then we had Hitachi Energy, GE Vernova, TND, Siemens, CG Power. All these are power equipment players, as well as other stocks like transformer rectifiers, ABB, Siemens, all of them also fell. Why? Because they're a part of this manufacturing supply chain. Then we had some clarification that came in, and this is according to CNBC-TV18 sources, that government has not yet made any decision on this front. There was nothing that has come in on this front. That is what we understood. But despite this also coming in as a clarification sorts that no decision is made as of now, these stocks continue to be under pressure. Almost 3 consecutive days that we've seen these stocks that are falling in the trading session. Now, today we spoke to IIFL's Renu Ved as well. And what she highlighted that, there's this one Chinese company, TBEA, that is likely to participate in power grids tenders for reactors. So what they understand, according to the channel check, high voltage reactors, maybe that restriction is likely to be lifted on that front. It's not a blanket rule that will come in across all these sectors, whether you look at railway, power, or other sensitive contracts for government bidding. So as of now, they've said that it only seems like it's only for this one particular maybe product that is being made on that. Now, even other brokerages have come out with their notes, and this came in last week, and they also highlighted, whether you look at Bernstein, they said the industry channel checks are suggesting relaxation is for some of the firms is likely, not all. The relaxation may be segment based with prior requirement on part of the Chinese firm. So they will require something as well in terms of a clarification, or maybe some requirement of approval that comes in before they actually start bidding. So as of now, obviously, we've seen negative impacts coming in from most of these players. We'll keep an eye out on that. Continuing for the third consecutive day, pressure on these capital good names.
Oh yes, this space continues to be on our radar. Any more updates, any more clarifications is something that the markets are watching out for. For now, we'll slip into a short break and just focus on the realty space up next. Stay tuned for that conversation. We'll just slip into a short break. Welcome back. Well, despite that massive recovery that we are seeing from the lows, real estate, the Nifty Realty Index is a top loser. In fact, it's down around 17% from the 52-week highs. We've been getting a lot of commentary coming in from real estate companies. Today, Signature Global highlighted that they will not be able to meet their pre-sales guidance of 12,700 crore rupees. They say that overall market sentiment has turned softer, which has impacted them. We've been talking about how there is some pressure on realty names or the real estate sector overall. But does it happen for all the markets? How far it could go? And what is the outlook going forward? We are now joined by Pankaj Kapoor, founder and MD Liasis for us, for understanding the real estate market scenario. Mr. Kapoor, good afternoon. Thank you so much for joining in. I remember we had spoken in November. You did indicate that there could be some structural changes coming by in the realty industry overall. Have things worsened since then? We have one real estate player, listed one, which is now talking about some demand softness. I think that's the first one that we are hearing now. Do you think we will continue to see this commentary coming by from more players in the near future?
In fact, if you look at the market has actually slided down around 7 to 8% from its peak, which was early last year. And post that, there is sales-wise, in terms of the unit, the market is down by 7%. But the major concern is the constructed supply, like the productions done by the developers. So even though the marketable supply has grown over the period of time because the builder launched the projects and also could generate the booking, but their execution is falling behind. So from 3 billion to 3.5 billion introductions of the marketable supply during last 3-4 years, the constructed supply has been holding at 2 billion, and sometimes it has gone down to 1.9 billion square feet. That means that builders are not able to keep in pace with the launch supply. The construction is not keeping pace with the launch supplies, and that is what is creating a structural issue. Builder will not be able to book the revenue, and there would be a default and execution delay in the projects, and which has a long-lasting impact on the overall real estate market projects viabilities, because if the construction slows down, then the interest cost and construction cost adds up, and then which impacts the margin of the developer. But in overall sense, that the volume have gone down by 6 to 7%. But in terms of the value, it is not looking that bad because the market was still skewed towards the luxury and ultra luxury market. And I think the demand softening is also from the angle that the prices have peaked in most of the geography. The investor participation has reduced because most of the geography, the price rise has been in the range of 0 to 5%. some of the North Indian market, which was showing a high price rises, are showing a plateauing situations because as the new launches is coming, the competition is coming, the price is not growing as much. So investor sentiment is a bit down, and luxury can't continue to actually support the market all along. The demand has to, or the supply has to meet the distributions of the demographic and demand segmentation. I think those corrections will be taking place going forward.
Mr. Kapoor, what you've highlighted is, from the peak, we've seen a 7% downtick in terms of volumes. Is there a particular geography where you've seen more stress compared to others? And you've also highlighted an important point in terms of real estate builders' balance sheet under a bit of stress due to not being able to launch on time. How worried are you?
I'm saying that this is not much of the worry, and mostly I see that like Delhi NCR already have a very limited supply because in comparison to MMR regions, if you see Delhi NCR, the total supply is 1/5 the size. MMR, if it has an unsold of close to 3 lakh unit, Delhi NCR is still holding at a level of around 60 to 67,000 units. So it is much limited and contracted supply as of date. But some market like Pune, we have seen a reductions big way. We have seen to some extent Delhi, Ahmedabad, Chennai, and to some extent in Hyderabad, there's a bit of a reductions in terms of the volumes. But overall market actually is holding up. In tier 2 cities also, we have seen a growth getting arrested. And one more thing which I noticed during this particular quarter, we have seen prices of around 18% projects across out of 20,000 projects we cover have shown a reduction in the property prices to the extent of 0 to 5%. So clearly indicating there is a softening of the demand in the market, and builders are finding it difficult to entice the investors, and they are trying to make the deal more lucrative, and that's where they started giving offers and discounts.
So, Mr. Kapoor, we just have a minute. So, I just wanted to understand the pricing bit. Was the demand slowdown a lot to do with affordability as well? And if there are price cuts, do you think that could revive demand?
My own sense is the market is post-RERA has really been highly dependent upon the demand and supply. So the geographies where the price rise been very high, like Noida, Greater Noida, Ghaziabad, and North Indian places, where there was a supply constraint because a lot of new supply was not coming in comparison to the rest of the geographies across India. The limited supply was giving an opportunity to the developers to really speculate and increase the prices because marketable supply was very limited. And my own sense is builder wants to really maintain certain cash flows, and so they have to maintain the velocity, and that's why they started offering discounts and offer. And it's more to do with the demand supply rather than other issues. And I'm not seeing too much of price correction risk because rental yield across most of the geographies are very good. Mumbai itself has touched close to 4% of the rental yield on an average. And that's kind of thing, above 3% rental yield we are seeing in majority of this geography. And that's where I see that the prices have productivity. We don't see a big price correction risk, but one thing is that the price rise is moderate, and so as the discounts offer also been in the moderate range of 0 to 5.
Got it. Mr. Kapoor, apologies, we are completely out of time, but thank you so much for joining us with your insights on what's happening in the realty space. A lot to do with the demand-supply issue, not so much pricing. But with that, we'll take your leave on this edition of Midcap Radar. Quickly taking a look at what's happening with the Nifty, 50 points higher and around 30 to 32 stocks in the green versus what we are seeing in the red right now. So watch out for that. We'll take your leave now, but closing bell will come up on the other side.